Okay, hello folks. Welcome to State of the Market. I'm David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everyone. This will be our last State of the Market of the year. Hope everyone has a great Christmas, holiday season, New Year, all that. We will, though, still be doing market trends on on Thursday at 2 p.m. That'll be our last webinar of the year. It's great to see everyone. Just showing some disclosures. We're also going to share a few other disclosures in the chat, including the prospectus page for some of the ETFs that we use. Now, we use these ETFs mostly just as kind of indexes for charting purposes to see where different sectors are performing. It's a convenient way to do things. We're still going to show you those. And also, let's see the standardized returns of these ETFs right here if you want to take a look at that. And so right here we have basically an interesting sort of calm drift. We for the last week or two have talked about the potential acceleration in large cap growth and the shift away from cyclicals, and that has more or less been the reality that we now see unfolding before us. And the question would be if the next thing is maybe, if anything bearish wants to happen, if that narrative might be talk of recessionary things. So I want to just first start off by just showing we have this idea of the volatility cycle. We kind of want to be thinking, where are we in terms of, um, you know, how volatile the market is, or the overall sentiment is. And right here, it puts us in the area of stock picking, less correlation, low volatility. This area here where people can feel good about things and be happy. And then the question is, at a certain point in time, does it turn into a complacency that then turns into a sell-off? But we're nowhere near that, obviously, just to kind of bear that in mind and just make clear that we are very much in the stock picking, low correlation phase of the market. If you also want to look, if you go to tradestation.com and you go to insights, you can look at our article for today, and we break down some things about the S&P 500 in this article here. The market is bracing for a less dovish Fed, and I think that's just kind of the narrative we now have ahead of us. The Fed is, by most indications, going to cut rates, and then after that, there will be a pause. How long of a pause, we're not sure, but there's a pretty high degree of certainty about this week on Wednesday, this is the 18th. Then after that, January, nobody's expecting a cut. And then we have all the way till March. So a lot of things can evolve in that time. There can be a lot of Fed speeches. There can be a lot of data. A lot of things can come out. So in many ways, even though March is showing the small odds of a cut, that really is not very significant at this point in time. The CME, Fed Watch tool doesn't have a lot of accuracy if you look out more than a few weeks. So anyway, I think it's just important to realize that in many ways, this is the last. I don't want to say definite because who knows? Maybe they don't cut rates tomorrow on Wednesday. But based on the view of the market, this is more or less the last, more or less definite or high probability cut. And after that, we go into a period when rates are no longer in play, and that may or may not be good. It is interesting to kind of realize that some of the recent speeches have been leaning more in the hawkish direction. There's a new lady on the Fed named Hammock, and then there's also Michelle Bowman. They were both relatively hawkish. So Jerome Powell is going to be speaking. He's going to put out the dot plot, and then the European Central Bank only cut by 25 basis points. So haven't talked about 50. So that is also kind of suggesting that we're kind of entering more now of a period where things go in the direction of less dovishness. And historically, that is not a positive, but we also have to be careful. There's nothing yet very negative on the chart of the S&P. I'll very quickly just show you our breadth workspace that we look at here, and you can see that the number of stocks in the S&P 500 above the 20-day moving average have been falling sharply. The new highs are falling, new lows are rising. The advanced decline line is weak. So the breadth here has been weakening. Is it important? I don't know. I mean, honestly, breadth to me has been increasingly a broken signal. But I want to emphasize that there are some of these signals here that show at this point there is a weakening. Now, other times when breadth has fallen, all it's done is signaled a bottom. I'm not sure how overall important this is, but I wanted to mention that we have seen, and people have been talking about, that the breadth has deteriorated very sharply in the last in the last 2 weeks, really, since about here, the kind of toward the end of November, we've really seen the breadth weaken here. So that is what's happening kind of in the background. So I think it's important to realize, we've been talking about the overall weakness in cyclicals, financials, industrials, materials, things like that, and they have played out very much as we expected. Before jumping over, look at the weekly chart. I want to very quickly look at a few things on the daily chart. For example, look at Steel Dynamics. This is one of these, Trump industrial infrastructure, whatever you want to call it, you know, complete inability to hold this breakout. Things like Nucor, these are steel makers, showing no kind of like real confidence. And you know, the materials thing, this is telling us that the market is starting to get more of a sense of a cyclical weakness coming. And I think this actually, we want to at least, we don't want to say that this is necessarily like confirmed as a thing, but the thing is that this is now kind of coming together as a potential narrative, and there's significant evidence that the next sense in the market could be cyclical weakness. And if we have cyclical weakness combined with a less dovish or a Fed that is locked into not cutting rates because of their dot plot or whatever, I see a regime in front of us, an environment in front of us of fears of a slowing environment and confidence that the Fed's not going to cut rates. And those two things together are not bullish. So I think we have to realize is that there is a potential narrative emerging in front of us. 2 weeks ago, the narrative was large caps breakout, AI spreads, all of that is played out. Now the narrative that is, it's sitting there. It's like a DVD you have to hit the play button on. It hasn't turned on yet, but that narrative that is sitting there is cyclical weakness starting to become something here. And that's what like the steel makers are showing us. There was some real selling. Look at these names like United Rentals got slammed here. You know, one stock I've been watching for a long time is Cintas. This company does uniforms, and they're kind of, in some ways, a measure of employment activity in the United States. They had this big, inexplicable liquidation. This was a downgrade, but this is a very significant drop they had back on the 9th. So these are all industrial. Well, the industrials and materials is an industrial name. So some of these names here, NDSN is another kind of industrial supplier, really got slammed recently. So I just think it's interesting now. We are starting to see some signs in these cyclical names of an overall weakness. And I think we have to at least kind of know that that's there. The Empire Index today was bad. The S&P Global S&P Global Purchasing Managers Index, the manufacturing side of it was bad. Last week, jobless claims higher than expected. So there are some things out there. So everyone's focused on the Fed, but I do want to emphasize also that tomorrow morning we have retail sales. And it could be a surprise narrative, a bad retail sales number tomorrow. It's beaten for 5 straight months. If we get a bad reading on that, the inflation narrative could start to assert itself. I mean, not the inflation, the recession narrative or the slowdown narrative. So I know things are doing well now, but I'm just trying to lay out what could be the next things that kind of takes hold, in the market. That's kind of what we try and do in this, the state of the market, where things are, but where they might go next. I want to be clear right now. A lot of these things are not giving anything negative yet on the bigger index. Before we move on to the bigger index, though, I do want to mention one stock. I might do a trading view idea on this, which is Fiserv. This is an interesting company that, excuse me, we actually written about it as it broke out of this nice high basing pattern back over the summer. This dropped because its CEO is apparently joining the Trump administration, but nothing fundamental, just kind of a weird news event. I wanted to put this on people's radar. It's another kind of fintech story. Some of these fintech names have been doing well recently. There's a name is like a quiet kind of growth name, like around 100 billion market cap. It's not one of these huge companies, but it's been an interesting uptrend. This is more of a swing trade sort of thing, but I want to throw that out there as one that I might do a trading view idea on. I did do a trading view idea today on Target, looking about the fact that this is hitting some resistance here. You can check it out on TradingView if you want. We did an idea on this, and this kind of fits into potential downside in a name like this. We just wanted to mention that some of these names, that right now in this market, if they're not good, they might be bad. And it's like, yeah, Tesla's good, Apple's good, Amazon is good, but then you have a lot of other names, and if they're not good into year end, they might actually give some kind of performance to the downside. And I think we have to maybe at this point in time, shorting some of the weakness, looking for downside in names like this might actually be an interesting strategy, because into year end, things that have been losing, they tend to have that window dressing effect into year end. All right, now let's turn to the big indexes, S&P 500. Basically, last week was the tightest range in like a couple of months. We wrote about it here in this blog post. I don't remember how long ago, but back here we mentioned we did some analysis, and we talked about how it was the tightest range in the S&P since the start of October. So that was interesting, a kind of tight range. And, we have now an inside week. We are still in an inside week from last week. And, that is a bullish pattern, but it also can be something where, if it doesn't, remain positive, it can turn into something negative. So I think we have to realize here, this is very inconclusive and just kind of has positive momentum behind it, but this is not breaking out to new highs. It's just kind of sitting. And, tomorrow this could not look as much of a positive sort of candlestick. So I think right now, if people are looking for a pullback, I mean, the strongest level that right now kind of jumps out to me would be back here around 58, 55. It was this level, the election rally and the pullback and hold. It was a high from here. People might look a little bit at these highs around 6,000, but these are pretty close. And from my perspective, if things do start to break down, given the fact that we're going into a period after the Fed when there's not a lot more news for the rest of the year, lower volume, lower liquidity, all that stuff, it could actually be something where things get more volatile around that time. And if people are looking for an environment where there's more volatility or more risk, trying to get long too early in the midst of a sort of pullback might be something that gets a little bit, it might be more prudent, more of a chance for people looking for a deeper pullback. So I want to just mention that the level that looks to me like a strong, interesting level to pay attention to, is around here. And not even, if there is a higher level, I would actually say it wouldn't be 6,000. It might actually be something around this 58.70. It was the weekly close back here on this week in November, and then the low the following week. This is right around Thanksgiving, but I mean, that is a potential one, but the one I'm really looking is this one back here at 58.55. It is interesting to look at the S&P on the daily and actually see that we've had a series of these solid candles, the early strength getting sold a lot. We had talked about this a lot in the Russell, and it's interesting to look at the Russell, all these solid candles. We've been talking about it in this kind of heaviness. We did an article, we did a trading view idea on JP Morgan, same thing, just totally solid candles going all the way. So again, early strength not sticking, and we've seen something of that last week in the S&P. Today's a Monday, but I do think it's interesting to realize that a lot of these recent candles have not held into the close. So that is the S&P. Now, the NASDAQ, we had basically talked about, it had this pattern of closing a new weekly high and it's just extending. And from my perspective here, this is something where this is the one that has the clearest strength. This would also benefit from the overall environment of, if people start talking about an economy it's not great, and they start talking about things like even stagflation, believe it or not, could be good for names like the mega cap growth names, because they have that secular growth and they don't have the problem of interest rate exposure or recession exposure. So if we actually do enter something of this idea of, oh no, the interest rates are not going to come down and inflation is still kind of high and growth is not that great, cyclical growth in the economy, that is something where people, I think, take a liking to the cues. I actually did something, I have to find it, maybe I can find it. I did this little joke meme of let me see if I can find it over on my other screen, but it was basically about the the um, the mega cap growth stocks being something of like a security blanket. And so I think that's a way to kind of think about it. Let me see if I can actually find this. This is kind of something I thought was a little bit funny here. This is kind of, I think if we enter a time when the interest rates don't necessarily go down, and we enter that kind of phase when small caps, financials, industrials are not great, then suddenly Tesla, Amazon, Apple, they give people a degree of comfort. All right, so let me go back now to the Dow. Essentially here, I think, is in a spot we had mentioned that there's a lot of space here. And from my perspective, this is something also where it doesn't have any kind of clear sort of support yet in place. This is something where it's been weak, and the risk is if we get some volatility, then it could get weaker and have some, kind of further presses to the downside. A lot of financial and industrial, and here we're going to get to those. And those charts, from my perspective, may actually have near-term sort of risk. So the Russell, I think, also is in a spot here where today it's benefiting from small cap and stuff. I got small cap is benefiting from what do you call it? From biotech. But essentially here, we have this double top in place. And this might be something where if things remain under pressure, there might be some desire to see it go back to the highs of the summer. There's nothing here that gives any sense that it's really stabilizing yet. This has been down for multiple days, and it has a single day with a bounce. People looking for any kind of weakness might look for something a little bit higher up. You have an interesting level here where basically it opened at the low that day, probed above, and then went under. And that's a level around kind of 23.87 on the Russell that might be kind of in play for some people there. So, I mean, that's something where maybe if we have a lot of optimism, we get a jump up toward those levels. But I think also This is one when I look at the overall direction, we have basically a failed breakout here, and the sort of cyclical narrative, like I said, with some of these names like the steel makers, the industrial and stuff, not really kind of showing, you know, they're showing, if anything, more near-term weakness, and it potentially puts the Russell at risk. So the big one we continue to watch is the 10-year Treasury yield here, and this is one that has this falling trend line that that at this point, this is kind of, I think, the most important thing. If we break up above this, I'd say even this high from back here in November, because that would really kind of obliterate the trend line that has been falling. So, from my perspective here, if you look long term, um, you know, right now the 10-year Treasury yield is only about 20 basis points above Fed funds. Fed funds comes down 25, but if it kind of goes back, it still could go up, historically about 100 basis points above, that could still be putting us closer to 5%. So I think we're still in a spot here where there is some risk of the curve continuing to steepen. And if that's the case, I think this is just something in the background here where if people want to say, hey, the Fed is behind the curve, there's going to be inflation, whatever, there is some risk here of the yields running away on us. And so I think we want to be watching this 4.5 level. That could really be, I mean, it's interesting. We actually have a trend line here, and this level, let me actually extend it across. This is now kind of, I think, our litmus test. A break above that could start to ring alarm bells, but if we stay below it, then it can be kind of, a continuation of the calm. Now we look at the individual sector funds, the XLB. Last week we were mentioning this, and as negativity and bearishness, and this has remained very much in effect. This level here under 88 looks like an area people might look to revisit, possibly even lower, down under 87. This low from July. So I think right here, when we look at the overall situation of the Fed, potentially not wanting to not wanting to deliver more rate cuts and all that sort of thing, weakness in China. This is now an area that has very little positive things happening with it. The XLC now is in a spot where you have a bullish inside week, but there's also, no clear opportunity in something like this. Is something where it's been up now for 5 straight weeks. This might be something where people, if anything, are looking more to be ringing the register. What we've really seen, what's interesting here, is we're seeing a little bit of a regime change within mega caps from communications and discretionaries to tech. And we're going to get to that in a second, but it's kind of what we've been talking about last week. And let's see if it kind of continues. Now, communications we just did. Let's look at energy. This is one that we have been perennially wary of. Crude itself had a lift last week from it was some weird technical thing because of what Biden was doing with, I think, Russian oil. And it basically created a bump in crude. What's very interesting is that the XLE did like nothing to the upside at all. So the market just didn't believe it, didn't care. And I think it's interesting here to kind of realize that the Chinese data today, it was retail sales data in China was weak. The narrative continues to be in effect that China is exporting deflation. And, this market is looking to me more and more what it was in Trump's kind of first administration, which was basically energy bad, tech good. And he might say he wants to boost American industry and small caps and coal mining or whatever, but the market is buying growth stocks, and that looks very much like we're going back to that world. And I think I'm going to emphasize that in a world of someone who's friendly for oil drilling, that is not friendly for oil drilling stocks. And so I think we remain kind of very much these sort of levels we've been watching on this have remained very important. And I think right now, a move below 85 or even down to 80, is very much possible. I think when we look at the overall trajectory on things, and we have talked at times, and let's take a look at crude really, really quickly here. Wait, that's the wrong crude, because we continue to. All right. This. Let me see if I can kind of show this to you. It has this weird thing from back in COVID time. Anyway, the thing is, there is a weekly level. The chart's messed up. I apologize. There's a weekly level if you look long term at crude, where I just wonder if it's going to give a drop like we had in 2014. And the thing is, we continue to see this environment here where the Chinese situation doesn't favor it. So I think downside in crude weakness in energy stocks is a theme we want to kind of continue to pay attention to. We had talked last week about Chevron being in this downward channel, and that really, that really has played out more or less as we anticipated. So I think we just got to realize here is that, right now energy remains a sick man of the market. Financials also are in a spot where they're trying to hold this low, but these guys have run a lot. And I think let's see what happens with this retail sales number tomorrow. It's important around the holidays. We also have housing starts on Wednesday morning. Housing stocks have not done particularly well. My sense is that the non-Amazon, non-Tesla part of consumer discretionaries, which include a lot of home builders, but also stocks like Norwegian Cruise Line. I was watching this and just look at some of these stocks here. These names look tired here. And I think we have to realize is that all of these have a certain degree of kind of connection to financial because they're value stocks. They are the kind of companies are going to benefit from, things like lower interest rates and a strong economy. They're cyclicals. They all kind of are in a same universe. And some of these cyclicals, I say, they're continuing to show signs of weakness, and financials are a strong area there. So if we look overall at financials here, if you look, we can see this is just making a series of lower highs. It's trying to hold this level right on 49 and a half, but then also we have this space, kind of down here. So I think we got to kind of watch and see. But this might be something that has that potential to kind of break down and get into that gap. Like I said, I'm not trying to paint an overly bearish picture of the overall market, but I'm trying to lay out where those opportunities could be if things swing in that direction. If the market wants to have a pullback, the Qs might not be the place where the selling happens. The Qs might just kind of do nothing for a few days, and you could see potentially carnage in something that is cyclical, like we're seeing right now in energy. Energy's down like 2 or 3%. People looking for downside in this. I mean, this is kind of telling us something. And I think something like financials as well, it's kind of parked at this gap. There's a lot of sort of optimism priced in around Trump. And if we get to a thing when people start having more of a fear of a kind of cyclical weakness, when you see the industrials, financials, the industrials and materials weak, does that spread to financials? So that's kind of what I was saying. Now, sorry, but getting to industrials, essentially here we have the same sort of thing where, we're not holding this low from this week here. Let's go back to the weekly on industrials here, but we're not holding the low. This is an uptrend line that is broken. And, from my view here, this is something where this is, might be the beginning of a sign of some weakness. So I want to put this out there. If we get into that idea of the cyclical weakness as the new narrative that comes in, this could potentially, kind of expand and spread and drag on the industrials. XLK, on the other hand, could be, very interesting because essentially here, it broke out this new high. Now it's important to remember that tech stocks actually have not been good since the summer. It's been all XLC, which is Meta and these other names, and it's been XLY, which is Tesla and Amazon. XLK has been kind of missing in action, and now here it is breaking out. So this is an area to me that people might want to look for potential acceleration. The XLK is about a third of the S&P 500. So it could simply be a question here of this sort of, coming back to XLK. And I think the other thing we have to realize is our friend, Mr. Semiconductor Index, Mr. Philadelphia Semiconductor Index here has been, the sick man of the NASDAQ. But the thing is that, at this point in time, it's making what could turn into a higher low here I think this is an interesting thing to kind of look at here. We could simply be seeing now, people saying, I'm tired of financials, but I am coming back to chips. And, that seems to be something of a potential narrative there. The opportunity, the things that happen in Broadcom, very, was an incredible move, surprised to the upside, and it kind of renews the enthusiasm and the love for semiconductors. So I think we look here at the semiconductors. We have this high from back here in October that we're still below. When you look at this on a long term, I mean, I think right here, this is something where people might start to say, you know what, this is now getting ready for some kind of breakout through those levels. It really hasn't done anything for a long time. And NVIDIA has more Blackwell coming and all that stuff. I want to put that out there. Remember, Micron reports later this week as well, which is potentially important for the chips. So that is to me, I think the main thing we want to be thinking about is that the XLK here, and we had kind of talked about this trend line that it's holding an inside week, and we held, and now we're just kind of inching above. So from my perspective here, this is actually maybe the area where people see the most opportunity. And don't forget, it's a third of the S&P. So the XLP consumer staples here, this is one where it's just kind of trying to hold on to these levels. From my view, this is something that actually does have some kind of promise. The way it's kind of holding this level. People looking, for an opportunity if it continues to hold this low from back here at the end of November. That might be an opportunity to kind of extend because we have this downtrend breakout. We're above the old high. This thing is breaking out, and I think this is actually something people might see some potential here, but overall, not terribly interesting. The real estate is more damaged, and this might be something here where it's trying to hold this level, but at this time, if we see upside in rates, this could be something where people look for a move down toward this 40 level that might actually make the most sense. Now, utilities, um, at this point also are in this serious chopping. When things go from being bullish to neutral, they often have a kind of washout before they get bullish again. So from my perspective here, people might want to be looking for something under 76 towards 75 in XLU. Maybe set some price alerts down there. See if we can probe down to some levels when it looks, where people might say that it's like oversold or something. But right now it's in this kind of like zombie drift. And sometimes when things are in this sort of drifting, you get a day or two that slam lower and give opportunities. Now, healthcare is now increasingly kind of damaged, I think. And we had talked about this having that kind of bearish risk last week, and it really just closed near the lows of the week, and it's breaking lower still. From my perspective, this has, this level toward 138, but this is something where people might really view this as a punching bag for a while. This is something that it seems like there is a longer term sort of issue with this as something that people want to own. It seems that the healthcare stocks, there's a lot of things like today there was news on some of the pharmacy benefits companies that they might crack the whip on them. And I think there's this giant, just like nightmare scenario for the healthcare stocks, which is that basically the government says we want to negotiate, or Medicare wants to negotiate drug prices. And I mean, the kind of damage that could do to earnings, I think, in the XLV, I think cannot be understated. So from my view here, this is something where people looking at the macro perspective, everyone is kind of now turning on the healthcare industry, Republicans and Democrats, and it seems like it's an area where people don't want to be. So I think people might want to kind of view this as an area to be looking, at least large money likely avoiding this with some potential for further risk, and probably need to get to a spot through several quarters or some kind of political process to have a sense where, all right, we know that the bad event has happened. People can look out and say it's going to be the drug pricing thing. There might be something with, the health insurers when basically the government didn't want to give them the full reimbursement rates. That's been his whole issue when you look into some of these health insurance stocks. There's a lot of things out there like that. So I think right now, this is an area that has a lot of negativity in it. XLY is, on the other hand, remains extremely bullish and, has clearly broken out. At this point, people might want to simply be looking for any kind of pullback. The level that might stand out that make the most sense would be this kind of high from back here, the first full week of December. But overall, this is an area where the individual names maybe are the area where people kind of look. I mean, this has risen several straight weeks, though. If anything, looking for an opportunity on a 1 or 2 week pullback is probably where people will be looking. But the thing is, at this point in time, even now, what do we have? Tesla's driving this. Well, Tesla's deliveries beginning of January. Then we have earnings season. So at this point, there's no, there's reasons to see the potential momentum continuing and a lack of selling and people not wanting to come in to sell this yet. So those are the ways I look at these things overall. Let's actually take one last look here at the S&P and see where we actually are on the day. Pretty much not doing anything. And, I mean, there is a little bit of a trend line on the daily chart. I'm not sure how incredibly important it is. But from my perspective overall here, I think we have to realize it's a Monday. We came into this week with a lot of positive momentum. We had the bullishness in Bitcoin and everything else that has really lifted sentiment. But tomorrow is Tuesday. There's that potential of a turnaround Tuesday. And then we get back to macro. The last real slug of macro news for the year comes tomorrow with retail sales, and then on Wednesday with the Fed, but also the housing numbers. And the home builders, we've kind of been mentioning the weakness in this area. I mean, this looks, when you look at this overall, this is something that also is not a sign that is overall good for, I think the overall non-Tesla, non-Amazon part of consumer discretionary. There's been a lot of consumer discretionary things that have not been looking great when you look away from those few big tech names. And like I said, things like the cruise lines, they've had incredible runs. And if you look at them now, they are looking fatigued. So I think you're at a spot where some of these names that are cyclical, look, a bearish outside day on this today with the market up. This is, I think we're just kind of seeing some of this. We're seeing more of the sort of leaders, the things that were really driving the market are struggling. So I want to just point that out. I mean, just individual names here, that's not really what we want to get into. But there are some signs of this sort of cyclical, thing that has run its course kind of fading. And then the question is, can the NASDAQ and large cap growth overall take over? Or do we actually have a period now where people say it's been a good year, and maybe, not to say there's significant downside in large cap growth or anything like that, but we could get maybe some stalling in the market, some period of sideways movement. Large cap could remain strong in that, and then some of these other areas like industrial, financial, materials, things like the cruise ships, those might actually see some kind of people ringing the register or looking to press the downside. So those are the main points for today. Remember, we will be back on Thursday with market trends at 2 p.m. Eastern. Hope everyone has a great day, and I'll see you on Thursday.